and welcome to Tax Matters. Welcome to the month of March. For the second month running now, VAT has been charged on eligible goods and services at the rate of 7.5%. Of course, that increase is one of the fallouts of the Finance Act 2019. Today, we want to continue looking at the Finance Act and its implications for business and commerce and the economy in general. So we have another expert in the house to look at the provisions of the Finance Act. Mr. Yomi Olubenro is a partner and West Africa tax leader at Deloitte. But before Olubenro comes on, let's get a sense of what the Chartered Institute of Taxation of Nigeria feels about the Finance Act. What is the official position of the CITN on the Finance Act 2019?
CITN is very, very happy that this is happening now. You know, when we visited the president, one of the issues we raised was that in every developed clime, the finance bill ought to follow appropriation. You cannot talk about expenditure without talking about revenue. And when you talk about finance bill, that is where the nitty-gritty of the revenue that you want to use is. So let's talk about it before the appropriation bill. And you see, give it to the president. Just give it to him. He listened, he has done it. And we are very, very happy about it. That is the way we should go. We should look at the income side before we talk of expenditure. And as we look at the income side, we want to look at, okay, is it only investment that will give me income? Is it only from borrowing that I will get income? If it is from borrowing, how am I supposed to pay it back? Now you look at your sources of income. Even if you are making a deficit budget, you want to look at the positive side, that this deficit budget, I will need to borrow money to finance some aspect of it. That borrowing, how am I supposed to pay it back? And we are looking at taxation for that. And that is the sweeping reform that we have seen now. And we are very, very happy about it.
Okay, Mama, which of the provisions in the Finance Act do you think will positively impact the Nigerian tax system?
Value-added tax.
It has been suggested in some quarters that the approval of the minimum wage and the increase in the rate of VAT means that the government is taking with left what the government is giving with the right hand.
I can't stop explaining this again and again and again. Now, what is VAT? It's a tax on consumption. Tax on consumption, especially of luxury goods. Government has given a lot of exemptions for what affects ordinary person. School fees, all basic food items, including, there was a controversy about bottled water. They have now made a pronouncement that bottled water is exempt. Most of the things that the ordinary person that earns 30,000 will need, most of it are exempt.
Do you provide goods and services? Then you must answer these important questions. Are you registered for VAT? Do you charge VAT on the goods and services you provide? Do you keep records of all your transactions? Do you file VAT returns? Do you remit VAT collected to government coffers? If your answer to any of these questions is no, then you are breaking the law. The law demands total compliance. Therefore, you must register for VAT. You must charge VAT on goods and services. You must file VAT returns. And you must remit all VAT collected on behalf of government within 21 days to the bank nearest to you. To do otherwise is a crime punishable everywhere in the world. VAT is prescribed by the law. Do the right thing. Collect and pay VAT. This message is from the FIRS. It pays to pay your tax.
Welcome to our guest corner. We have joining us on today's episode of Tax Matters, Mr. Yomi Olubenro. Mr. Yomi Olubenro is a partner and West African tax leader at Deloitte. Mr. Yomi Olubenro, welcome to Tax Matters.
It's great to be on the show. Thank you for inviting me.
Why is the Finance Act so much talked about?
Well, it's for many reasons. Since the return of the country to democratic dispensation since 1999, it's the first time that we're going to be having a finance bill that eventually got signed and became a Finance Act. This is one of the ways many of us have canvassed for, amendments to be passed into our legislations. We know that we have several tax laws that are, if you like, a little bit outdated. Our Companies Income Tax Act is a 1979 act. So we have tax legislations that are older than, many tax professionals today. So there's a need to tune them to modern reality. So what this Finance Act did is to take a look at 7 of the existing tax legislations and make certain amendments that will improve the ease of administration, that will address some of the concerns that taxpayers have raised in the past, provide some palliatives, and make sure that our tax laws are fit for purpose. So that's why the excitement is in the air.
I can see you're excited.
Absolutely, I am excited. I think it's there are 2 things that have happened in the fiscal landscape over the last couple of years. This is the second most exciting thing that I think has happened. The other one was the national tax policy. I loved it, and because those are the kind of things that the country should be doing. So having this Finance Act passed, even though it appeared to be a medium or short-term measure to solving part of the regulatory issue, it's a huge relief and a welcome development. And to have been part of the process is also very, very heartwarming.
Now, what would you say are the highlights of this Finance Act?
All right, so there are 4 key pillars that you can categorize the changes in the Finance Act. There are nearly 100 provisions, like I did mention. It's about a 30-page document. So it touches provisions in the Companies Income Tax Act and make changes. And the Companies Income Tax Act is by far the one that had the largest share. Personal Income Tax Act, Petroleum Profit Tax Act, Capital Gains Tax Act, Stamp Duty, and then Customs and Excise. So essentially all the 7 tax laws were amended. Some of the changes try to address some regressive provisions in our tax law. So, for example, the number of provisions that have outdated their use. Okay, changes were made to reduce some of those burdens and make them a lot more relevant. 2, there are newer provisions that you require to tax businesses in the new world, in the digital space. So there were a number of changes that were made to make our tax law to be a lot more reflective of what the global business dynamics say. So that's the second one. There are some provisions that were aimed at curbing loopholes and anti-avoidance provisions. So taxpayers get increasingly smart, and so there are provisions that they could use to their advantage. So a couple of the provisions try to focus on anti-avoidance, and of course the 4th pillar is about revenue generation. So if you pick each of those pillars, you can see where many of the talked about provisions are. So if I pick them one by one, on the revenue generation side, we note that VAT was increased. So there were changes in the Value Added Tax Act to raise the VAT from 5% to 7.5%. Within that same provisions, within the same bracket of provisions that are aimed at increasing revenue, we have excise duty, for example, laws made in the Excise Duty Act that subject imported excisable item to tax. So, for example, in the past, prior to this amendment, alcohol, alcoholic beverages and tobacco that were manufactured locally were those that were subject to excise duty. If you bring them in from outside of the country, you don't pay excise duty. You only pay the normal customs duty. That appears a bit discouraging to local manufacturing, because if I can bring it in cheaper than it is to manufacture locally. The product then become a lot more better to be brought in than to be manufactured. So there were changes that then says all excisable items, whether you manufacture them locally or you bring them in, you would subject them to VAT. We have changes that brings multinational companies that operate in the digital space that were previously not being taxed in Nigeria. You know, we made changes to make them liable to tax if they have significant economic presence. So a number of provisions like that try to increase revenue for the government. Now, but within that same bracket, government recognizes the fact that if you raise revenue, there's going to be the impact in the economy, the inflationary impact, the increase in cost of input and all of that. So government then provided palliatives in order to make sure that the people at the low end of the spectrum, you know, are protected. And that's why you have within the VAT Act changes, the micro and small businesses were exempted from the obligation to charge VAT, the obligation to file monthly VAT. Those are part of the cushioning. Part of the incentive also to the MSMEs is that they're no longer liable to companies' income tax. And by MSMEs, for both VAT and CIT, the revenue threshold is 25 million naira and below. And even if you have more than 25 million, for the micro business that are below 25 and 100 million, the income tax rate was lowered from 30, which is the standard rate for everybody, to 20. So those are the kind of changes that, you know, were introduced to kind of combat or cushion the impact of the increase, you know, that you could have. If you look at some of the provisions that were aimed at addressing the regressive section, so large corporates have always been faced with what we call excess dividend tax. So it limits the amount of dividend you could pay out. Otherwise, you pay an additional tax. That rule was changed so that the impact of double taxation was eliminated. Minimum tax rule was changed. Businesses that are commencing business newly and those that are ceasing business had always faced this double taxation impact at the point of new entrant or at the point of exit. Those rules were changed. VAT remittance before had always been on an accrual basis. So meaning if you invoice a customer today, by the 21st day of the following month, it doesn't matter whether the customer had paid you or still owing you, you'll be required to go and look for the money. So it's on accrual basis, on invoice basis. That rule was changed to say no longer will you be asked to go and borrow money to fund tax. You only remit what you have collected. So those rules were changed. But it's not all of the provisions that were aimed at just addressing regressive provisions. Some of them also try to introduce some new provisions that will fight, for example, abuses. So think capitalization, for example, is one of them. So by think capitalization, we mean a cap placed on the amount of interest expense you could deduct in a particular year. Before, irrespective of the amount you borrow, whatever amount you pay by way of interest, you charge it against your income as a deductible expense. But now there's a law that says deductible interest is now capped at the maximum of 30% of your EBITDA. You know, whatever you're not able to deduct in 1 year, you spread it over the remainder of 5 years. So there were provisions that, even though they weren't intended to stiffen business, but the provisions were created to make sure that intended abuses can be curbed. It's within the same bracket that you have provision for tax ID for businesses. So we know that the number of people who are registered for taxes in Nigeria and who are filing tax returns is relatively low compared with the total number you have on the CAC. So there are provisions that says for the small businesses, or anyone for that matter, to operate bank accounts, you need to have your tax ID. So you can't have tax ID unless you are registered with the taxpayer and with the tax authority. And when you are registered, the revenue authority then have ways and means of following up with you and checking your level of compliance, you know, and all of that. So, but by and large, if you take a holistic look at the entire provisions, almost 100 provisions, and if you group them together, without any iota of doubt, more than 3/4 of those provisions are actually aimed at easing tax burden and providing some bit of benefit to the taxpayer. The remaining 25%, we hope ultimately will help us to get more people into the tax net, close abuses, and ultimately raise revenue for the government.
The Federal Inland Revenue Service FIRS calls on all corporate organizations operating in Nigeria to register for the purpose of payment of taxes and obtain a tax identification number TIN. All registered companies must obtain a tax identification number immediately from the nearest FIRS office. You can also collect and return tax registration forms from the Federal Inland Revenue Service Engagement and Enlightenment Tax Teams, FEAT, on compliance checks exercise in your area. A company which is yet to commence business after at least 6 months of incorporation must pay a pre-operational levy of 20,000 naira in the first year and 25,000 naira for subsequent years to obtain its tax clearance certificate TCC. Note that filing and payment of VAT and withholding tax returns must be done on or before the 21st day of every month. Register for VAT. File all tax returns as and at when due. Be a responsible corporate citizen of Nigeria. It pays to pay your tax. This message is from the Federal Inland Revenue Service.
Welcome back. We are still looking at the Finance Act 2019 and what it portends for the different sectors in the Nigerian economy. Mr. Olubenro shed more light on some of the positive fallouts of the Finance Act as they affect micro, small and medium enterprises.
Zero CIT for MSMEs is perhaps the best you could have. Okay, the only other level of incentive anybody could think about is for government to actually provide subsidy. So if I have zeroize your income tax obligation, so I'm saying no matter how much you make, plow it back into the business and continue to use it as an investment fund for your business. Grow it to a level where hopefully, ultimately, you move from being a micro business, a small business, to a micro, and you pay CIT at a lower rate. And if you continue at that particular rate, you can then move to the big boys group of like taxpayer paying tax at 30%. So I think it's very huge. The VAT issue, it's also significant. Part of the reason why the country had always suffered on the ease of paying taxes and all of that is because of the burden on the lower end of the spectrum. You have so many people. We have close to maybe 100 million MSMEs registered in the business. So if you interview 5% of them and they complain about the multiplicity of taxes, the number of taxes to pay, the burden to pay, your rating isn't going to look good. So now we're providing that level of incentive to say, look, you no longer have that obligation. I think it's a fantastic provision. But generally also within the VAT, I think the additional benefit or additional incentive that the government also provided was that in as much as government knows MSMEs have been exempted, they are still going to be paying for the increase from 5% to 7.5%. We can lose sight of that. Okay, so there will always, you can raise your VAT from 5% by 50% to 7.5%, and you will expect it to be business as usual. Cost of input will increase. Some of the micro businesses that are no longer going to charge VAT will still have some of their inputs liable to VAT if they buy from large corporates. All right, or anyone whose turnover is more than 25 million. So it may have raised the cost of input in a way, and it has some bit of inflationary impact. So what government is trying to do is to balance it. But one of the extra measure that government took to make that pain a lot bearable is to expand the definition of basic food item, which is one of the item that is exempted from VAT. So sometimes people don't realize that it is not all product and services that are liable to VAT. Yeah. We have list of exempted product, we have list of exempted services, medical product, educational product and services, basic food item. But the basic food item has always been one that generates some bit of controversy. All right, so it's water. Basic food item because I get it directly from the tap, or when I package it in sachet, or I package it in bottle. All right, so it's bread basic when it is processed, it's yam basic when it is processed, and all of that. So what this new Finance Act does is to expand and add to the list of basic food items so that the commonly eaten staple will not be liable to VAT. So that way, we're able to further cushion the impact. The pain will still be there, but it will be a lot more bearable.
For clarity purpose, this provision that exempts small business owners with turnover below 25 million naira from paying CIT, someone asked that if it means exemption from paying all taxes.
Okay, so there are many taxes. Some taxes are charged on profits. So that's the one you call the income tax. So if it's a company, it is company income tax. If it is personal, it is personal income tax. There are also indirect taxes. So indirect taxes will be taxes like VAT, like excise, like custom, and stuff like that. So for small businesses, they were ordinarily liable to tax on their bottom line, on their profit, at the rate of 30%. We used to have a 20% rate, but the turnover threshold in the old legislation was about ₦1 million for agri and manufacturing businesses, which essentially mean nothing. All right. So, but with the new Finance Act, if a small business with a turnover of ₦25 million prepare his account at the end of the year and have an amount of profit which ordinarily should have been liable to tax at 30%, the law says it will no longer pay any income tax. So it is zero CIT. The only obligation that still exists as far as the CIT is concerned is that returns are still expected to be filed, to be submitted. So exemption from tax is not an exemption from submitting your returns, but that return is for the purposes of documentation, it's for the purposes of verifying the accuracy of your submission, because theoretically somebody could be making 50 million naira and claim to be a micro business and not paying taxes. So the claim for 25 million naira still need to be validated, still need to be reviewed, but for as long as the facts are there, because facts are sacred. So if you meet the revenue turnover threshold of 25 million naira and below, you will not pay company income tax. If we didn't have a specific provision in VAT, that wouldn't have covered them, because each change affects specific tax law. Companies Income Tax Act is what you use to determine the liability of company to income tax. You go to VAT Act to check what is liable, who is liable. You go to personal income tax to check what is liable and what is not liable. All right. So, but in the VAT, we also have similar provision that absorb companies of small business, from the liability to be charged in VAT and to be rendering monthly VAT returns. Unlike the Income Tax Act, the VAT provision actually means you will not be required to charge. You would also not be required to submit a monthly VAT return. So the whole administrative burden is eliminated. But of course, if you have other levies and charges, the intention might be to provide a holistic exemption, but we can expand it beyond the specific tax law that were amended. So there's still a number of levies and charges that are collected, say at local government level or at state level, outside of companies income tax and outside of VAT. So those ones will be assumed they still apply, and that's part of the cleanup, that we're expecting, because the overall policy thrust is to provide that incentive to micro businesses. But I can't see any change like that in the Capital Gains Tax Act, for example. So meaning that if a micro business sell an asset that is liable to capital gain tax, which is supposed to be under Capital Gains Tax Act, the intention might be no tax for MSMEs, but the reality is that based on local legislation, they still may be liable to Capital Gains Tax Act because there were no specific changes made to Capital Gains Tax Act. Education tax is another one where all companies, whether small or large, were meant to pay 2% education tax on their assessable profit. There isn't any specific change in this Finance Act that touches on education tax. So these are the kind of gaps that the administrative framework and the operational guidelines should address, so that there is no confusion between the intention and the clear provisions of the law.
There you are. Because of time constraints, This feature on the Finance Act will have to continue in a subsequent episode of Tax Matters. We want to thank Mr. Olubenro on your behalf, just as we thank you for spending time with us. See you next week.